Hooty hoo, all my stock market gamblers. Welcome today. I'm Tall Mike. So glad you're here. Day after Thanksgiving. I wasn't going to do a video today, but I miss you guys. So what do we got going on in the markets? Well, the markets are just closing right about now. Dow's up about 150. Nasdaq's down 50. So what we've had this week is kind of an upward drift in the stock market, right? We're going up, but the volume this week has been very light. So basically the market's rising on volume that's decreasing. Now that's telling you that we're close to the end of this big run-up. Now we've had a 15% run-up off of the lows. Now historically, the time between Thanksgiving and the end of the year is very positive for the stock market. On average, the S&P closes up about 2.5% in that period of time, from the week of Thanksgiving to the first of the year. Usually rises on average about 2.5%, and the Nasdaq on average rises a little bit over 3%. So why am I looking to short the market? Well, once again, the market has had this big run-up of 15%. Now, if we can get the SPY above the 200-day moving average, which I think it will do, maybe the Monday or Tuesday of next week, it might pop its head up above the moving average, the 200-day. Now, I think that's a great shorting opportunity. Now, granted, we're in the strong time of the year, but we'll see if they're able to hold this off until the first of the year. Will they be able to keep the market up? Now, I don't think they will. I think maybe we'll get the volatility where we come down and bounce back up right at the end, but I think that they're going to have very hard time of holding the markets up at these levels. The S&P is not going to stay above the 200-day moving average very long before it comes down and retests the low. I think we're going to have another 15% drop coming back to retest that low, and maybe even a bigger drop to take out that low. We'll see how that plays out. That's just my take on the market. All right, so let's move over to the housing market. Now, I get a lot of comments from people in the housing market. Well, they comment that interest rates are not high, or they're going to come down. They say they are high. We went from 3% on mortgage rates up to 7%, right? All right, so we're sitting right about 7%, hovering maybe a little below that right now. But a lot of people believe that the rate will come back down to 5% or 4%, or maybe even back down to 3%. Now, they could be right. I'm not saying they're completely wrong. I just disagree with that. You see, what we've done is we've held these rates so low for so long. They've been held artificially low, and now it is true we've had that big increase at a very quick pace. I mean, I can't remember a year where the interest rate on mortgages actually doubled. We've doubled basically from below 3% up to 7%. That's better than a double. I can't remember a time they moved that quick. But now 7% historically is not high. Historically, 7% is about normal. Now, historically, I mean, a lot of young people, if you're 30 years or younger, you've never seen interest rates up here. This would be considered high to you, but it's really not. It's just pretty much the normal rate of interest. Now, we've had interest rates at 7% before. We've had them at 10%. We've had them at 15%. 18% we've had interest rates. But what we haven't had is where houses are this unaffordable. Okay, so normally household income to the price of the house, normally that runs about, 7 to 8 times. Okay, so where are we at right now? Well, it depends on your area. We're basically between about 12 and 15 times. So we're at double the normal rate, which makes houses extremely unaffordable. We've never had that before. Even before, when we've had 15, 18% interest rates, people could still go out and buy a home. Now, I'm not saying that money is extremely tight right now. It's really not. If you want to go get a mortgage, they'll probably give you one. Go into a bank and try to get a mortgage. They'll probably give you one 7 to 8%, right? Okay, so money is still out there. Now, what can happen is the money is going to start to tighten up. I think we have a liquidity problem. I think we have a liquidity problem in the banking industry and in the shadow banking industry. industry. All right, so why do we have this liquidity problem? Well, once again, rates went from 3% to 7%. But the banks and the shadow banks, now a shadow bank would be like a mortgage company, let's say, like a Rocket Mortgage, right? All right, so these companies, they make mortgages. They make loans to people that are buying houses or refinancing houses. Now, a lot of them, they hold the loan so that they can bundle them up and sell them later as a mortgage-backed security. But a lot of them got caught holding these loans that they made at 3%. And when the rates went to 7%, these loans went down a lot, right? So that dried up the liquidity in the marketplace. The marketplace, the liquidity, there's not enough money to make loans right now. Okay, for example, we have a lot of zombie companies out there in corporate debt I'm talking about now. A lot of companies that can't even bring in enough money to make their interest payment on their current loans, but they need to borrow more money so they can stay in business. Well, this money is now drying up, and you're going to see a lot of these zombie companies going out of business. A lot of people will lose their jobs because they're going to, well, the company's going to disappear. They can't get money. There's going to be a liquidity problem. All right, so there's people that have these office buildings, right? Now, my accountant, he's got several clients that own office buildings. And office buildings, they don't have 30-year mortgages. They refinance about every 5 to 7 years. They have to go get new money. And now what's happened is a lot of these buildings, they're running between 50 to 70% occupancy rate. So they're 30 to 40% vacant, right? So when they go and apply for a new loan, because they have to apply every 5 to 7 years, well, the lender goes, well, but you're not bringing in the rents anymore because your building is basically 30 to 40% vacant. All right, so they're not bringing in as much money, and yet rates have gone from 3 to 7%. So some of these people are not able to get financing for their building. So what do? Well, my accountant's already had one that's just given the keys back. Now, who owns these mortgages? Well, these mortgages are owned, well, they're owned by a lot of people, sometimes banks, sometimes pension funds, and but basically there's people that are getting hurt because people cannot get new money to finance off the old money. So there's no liquidity out there in the marketplace for things like office buildings, for things like zombie companies, and soon for things like houses. Now, maybe the rates go down to 5%. I'm not saying they're not going to go down to 5%. They could easily come down to 5%. All right, but the money could still become much more tight at 5% than it is at 7%. At 7% right now, you go into a bank, you got 5 or 10% down, they'll give you the loans. But what if it comes back down, but the money starts to tighten up because of the liquidity problem in the banking system? Well, maybe they require you to put 20% down. Maybe they don't even give you a loan if you have a low credit score. Your credit score is below 700. Maybe they say no loan for you, right? So as the money starts to tighten up, it could have a 5% interest rate, but you may have to go find alternative forms of finance. Look, they require you to put 20% down and you only have 10% down. You may have to go find what's called a hard money loans, kind of like a loan shark, right? Or they go and they give you the 10% so that you can come up with the 20%. And that 10% may be at 12, 14, 15% interest rates so that you can get that loan so that you have enough money to put a down payment so the traditional banking system will give you a loan. But the money is starting to get tight right now. Okay, so this debt bubble that we're in, and this bubble is way bigger than it was in 2008 when we had the subprime mess, right? Corporate debt is 3 times what it was in 2008. Now, who owns that debt? Well, a lot of it is the Federal Reserve. Now, the Federal Reserve, before they could not loan to corporations. It's just in the last 3 years because, of course, we're in an emergency situation. Apparently, we're still in that emergency situation because they're still making corporate debt. So they're holding a lot of this corporate debt. But their money is starting to dry up. There's a liquidity problem. So these banks that were making the loans, now here's what they were doing. And the shadow banks also, things like Rocket Mortgage. So they have this loan, right? and they have this loan at 3%. And the loan is an asset, so they could go out and borrow against the loan. So they'd go out and borrow money so they could loan that out, and they could get another 3% loan in there. So they were getting leverage, basically. They were leveraging so they could do more business. There's a lot of leverage in the system right now. But the banks were borrowing money on the loans they were holding. But what happened to the loans they were holding? Once again, the loan price went down on the loans they were holding. So what's going to happen? Because they were using that as their collateral. Well, who were they borrowing from? Well, they were borrowing from the Federal Reserve. They're borrowing from other banks. A lot of banks are intertwined together. But actually, as the value of those mortgages go down that they're holding, that's the collateral that they were borrowing against. So the banks might actually be the ones that get the margin call. This liquidity problem is really starting to take effect. The money's starting to dry up. This is going to become a big problem, probably a huge problem, probably a black swan event coming in 2023 is going to be the liquidity problem in the debt market. They're not going to be able to make loans to houses. They're not going to be able to do the corporate loans. When that office building needs to be refinanced, there's going to be no money to refinance it with because the market is drying up. And once that debt market dries up, it's in big trouble. It's in real big trouble. The debt market is what is going to explode every bubble out there. When the debt market goes, the housing market goes, the stock market goes, the bond market goes. It's all attached to this debt bubble. And the debt is drying up. There's no liquidity. Now, granted, the Fed's going to print trillions and trillions and trillions of dollars trying to give it more liquidity. But at some point, it does break. At some point, it's just like pushing on a string. You cannot put enough liquidity into this marketplace to make it stay up at the prices that they're up. So something's going to give. And I think that's going to be the prices. I think it's the prices in the stock market, the prices in the housing market. We'll see how it all plays out. Now, I know this is Thanksgiving weekend and all, and I hope you're all out there having a great time because it's a great weekend. It's a great time to be with family and friends. And I'm so thankful for each and every one of you guys. I have somewhere to go that I can talk to without getting yelled at back. Go ahead and leave me a comment. You can even yell in it if you want. I'm Tall Mike. Get out there, everybody. Have a great rest of your Thanksgiving weekend. But don't forget, give me that thumbs up. Why not? It's the weekend. Bye-bye now.